to this module, Distributable Net Income, otherwise known as D&I. In this module, we'll be discussing what is considered distributable income for the trust.
At tax time, this is to do with the management, the ownership of assets. Put your money in a trust and never pay taxes again. Once again, that is not true based on the type of trust you create or what you do in the trust. Let's look at or recap this IRS section 643 once again in a bit more detail because it's going to be relevant to the rest of the conversation. Now, in the case of 643A, distributable net income, okay, in the case of capital gains and losses, here's what it says. Gains from the sale or exchange of a capital asset shall be excluded if they are allocated to the corpus and not paid or required to be distributed. Remember, this is a complex trust, okay? In the case of a simple trust, you have to distribute it. In the case of a complex trust, there is no requirement, okay? There is no requirement that the trustee has to make a distribution. In the case of extraordinary dividends and taxable stock dividends, this is money from the LLCs or your business. For purposes of this section relating to trusts with distributed current income only, they shall be excluded those items of gross income constituting extraordinary dividends or taxable stock dividends that are allocable to the corpus under the terms of the governing instrument. Yes, in this situation, all three of these clauses are built in, but this dictates that will be allocable to the corpus and it can sit there, and that's the governing instrument. The trust has this language provided in it. Let's keep going on to the next one. Okay, still the IRS code. Definition, applicable. Abusive transactions like this, remember, this is a part of the code. The IRS has prescribed, the lawmaker has prescribed, you're not the grantor in this case. The economic interest passed to the benefit, yes. You're relinquishing your rights on the property and passing those rights into the trust for the beneficiaries. They have, again, a beneficial interest, an economic interest in the property that's inside of a trust, whether business or personal. Okay? So yes, they have a direct benefit. And finally, does the taxpayer, so you, when you convey the property or sell it, do you feel any tax restrictions? And the answer is yes. Yes, because now you're governed by a whole separate set of tax codes that are relevant to your trust that are different from you. In this case of a simple trust, where a person can create the trust, they are the grantor, they are the trustee, and they are the beneficiary. You can see the situation causing problems where if I wanted to evade creditors or lawsuits, I can put my assets into this trust, okay, where I am the grantor. Perhaps I appoint a different beneficiary, my wife or somebody else, but I am the ultimate beneficiary, okay? The trustee is somebody else, but I am the beneficiary and the grantor. And after the lawsuit or creditor action has passed away, right, has evaded, I can go back and reverse these transactions, and and all of this can be back in my name. So you can see in this scenario, it appears to be a sham, right? It's simply to avoid tax burden or some other legal consideration. In our situation, we are creating a trust where you will have a material change of position. There's an independent trustee who's not the beneficiary, who's not the grantor, that's you. The beneficiaries will have a claim on the property, and economic benefit is passed to them. And finally, there are tax restrictions because now you have a whole separate set of tax codes that you have to follow. So all of these different tests meet our trust. Let's keep going on, folks. Finance, okay, this is an internal document from the government once again in the finance section of the Senate that I pulled up. Here the Senate says the elements of the doctrine. There's a lack of uniformity regarding the proper application of the economic substance test. Some courts require conjunctive test, which means that it is an objective test, that you have to show some economic benefit. which means that the property that's in the trust, the securities, the crypto, the house, the investments, the vehicle, whatever else is in the trust is real. It's making a difference out there in the economy. And in your case, yes, it's your property. You're paying property taxes. You're paying utilities. It's stimulating the economy in some way, right? These transactions are going on. Same thing with your business. You have an actual company. This is not a sham company, a ghost company with no employees. You have a real business, with transactions that you can show that are in place with customers, with consumers, etc. That you're not just creating a fake dummy company just to get the tax benefits. Okay, so that is the second business purpose. So one is economic substance. Does the property of the trust have an economic transaction? Yes. Business purpose, it's a real business. And so what this is saying is that the courts can take one of three approaches. One, they need the economic test. The second is a business purpose. Or the third one, where you can show either of these. Once again, our trust, passes all of these tests. And even if it ends up ever getting sued or audited, and the court or the IRS or the other party brings up these tests to prove whether or not your trust is real, you can easily pass these, okay? And we'll help you with that. Let's keep going, folks, okay? This is from Justia, which is one of the largest databases of cases. So in here you can see, in a particular case I pulled up, the court held that while for federal tax purposes, the distributions were deemed to be deductible by the estate by reason of 643. The question whether the trustee should have distributed these amounts was governed by the terms of the will rather than local law. Since under local law, the term of the will, the amounts received by the trust were required to be treated and held in the corpus, the court concluded that the amounts were properly deemed gross income of the trust permanently within the meaning. The court flatly rejected the government's theory that the gross income being received by the trust should be deemed income distributable to the individuals, okay, with the beneficiaries. In other words, you having a complex discretionary trust can determine under the terms of the applicable trust document, which in this case we have all those clauses in there. That's up to you. And if you determine, and the governing document determines that the sale of proceeds shall be classified and held in the corpus and up to the trustee, then that's exactly what it should be. The local law, state law, is not going to determine that. The decedent's will is interpreted by local rather than federal law. Okay? So that's what this is. Here is the case outcome. Gross income being received by the trust should be deemed income distributable to the individual, non-charitable, and hence was not required to be set aside for the charitable purposes. So decedent will, Okay? So even though the court tried to argue that it should be taxed, the court decided, so the IRS argued it should be taxed, the court decided no. Let's look at the governing document. Look, there are tons of additional cases around this. Trust property cannot be held under attachment or sold upon execution for the trustee's personal debts. Yes. The fact that the trustee holds the property does not mean the trustee owns the personal property. You have a legal title, not equitable title. Just like a mortgage. If you don't pay a mortgage, even though you're the only title holder with the state and the county where you own the property, your bank has an equitable claim. They can take you to court and repossess the property if you don't pay them. Okay? So these are all useful. You can read these.
This is the end of the module.